Welcome to the Canadian Investors course, Session 12 on options. Please note slide 2, as before, terms of use and disclaimer. It's been fully read to you in the introduction section, and we'd encourage you to read it now again. Stock market optimism. It's like lemmings running off the edge of a cliff. The options market is all about leveraged investments with a defined timeline. You have limited liability when you buy an option because the most you can lose is what you put up. The problem is the timing. If you get the timing wrong, you get it wrong. You have to remember that 75% of options contracts that are created expire worthless. If you're a buyer of options, that means you have 75% risk of failure. If you don't, and so getting your strategy just right is very important. We'll show you how you can take advantage of that later on too. First of all, let's talk about some terminology. A call option is an option you buy when you think the investment will go up. It's the right but not the obligation to buy a stock at a specific price within a specific time frame. A put option is the opposite. It's what you buy if you think the investment will fall. It's the right to sell a security at a given price and at a given time, but without the obligation to do so. One contract represents 100 shares when you're talking about stocks. And for the purpose of this exercise, we'll stick to stocks, although options can be created on many underlying securities. The time premium is the extra money you pay for the time to expiry. So in other words, the longer the option is until the expiry, the higher the time premium will be. So let's jump to some examples. An investor likes Potash Corporation of Saskatchewan, which is POT on the TSX, and we'll just pick an arbitrary time so that the numbers are all accurate. November 14th, 2016. The price was $23.95. At that price, the dividend yield on potash was $2 and it was 2.25%. And at $23.95, the investor really likes the stock and wants to buy 1,000 shares because he thinks it'll go to 26 by mid-January 2017. So what are the options? No pun intended. Well, you could buy 1,000 shares, pay your $23.95, put up $23,950, own the stock, and collect the dividend too. Or you could buy 10 $21 call options that expire January 20th because you're so sure that it's going to go to $26 within that time frame. And if you do that, the cost is only $3.10 for the premium times 10 contracts times 100 shares per contract times $3.10 the price for the option is $3,100. So which one do you want to do? Put up $23,950 or put up $31? Well, let's look at buying an in-the-money call option. So you buy 10 potash January $21 calls for $3.10. That's what we just talked about a minute ago. Gives you the right but not the obligation to buy the 1,000 shares at $21 before the January 10th expiry. Actually, on or before the January 10th expiry. The $3 premium is broken down into $2.95 of intrinsic value because it's a $21 call, $23.95, that's $2.95 of intrinsic. The difference is the time premium, which is 15 cents. If potash goes to $26 by January, the option will sell for a minimum of $5, which is 26 minus 21, for a minimum of 52% return. That's $1.90 on $3.10 invested. That's a fabulous result in a short period of time. Now, you could make it even more attractive by buying an out-of-the-money call option. So you buy 10 $24 puts, the stock was $23.95, and they're only $1. So it costs you $1 times 10 contracts times 100 shares is $1,000, which is the most you can lose. And if potash goes to $26, the option will sell for a minimum of $2,000, so that's at least a 100% return. Now, if you think that potash is actually going to go the other way, and it's going to go through $21 by January 2017, maybe you buy an in-the-money put. So you buy 10 potash $26 puts They're $2.50 a contract, gives you a total of $2,500 that you put at risk, gives you the right but not the obligation to sell 1,000 potash puts at $26. If the stock goes to $21, the option will be worth at least $5,000 or 100% return on your investment. Also a nice idea. Don't forget, if it doesn't happen within your time frame, you're sunk. So what's the other side? Well, we said there were two sides. There's a speculator, which is what we just showed you. Then there's the conservative investor. So which one are you? There are buyers, speculators, and there are sellers, conservative investors. Sellers of options are called option writers. So option writing requires the rules-based investing approach to increase your chances of success. If you practice rules-based analytical approach to determine what's the proper time and price to write a put option, your chances improve vastly. We suggest that you review rules-based investing in section 16, or just carefully listen to all the sessions up to and including and through session 16 to get the full benefit of the course. Option writing. Let's take this potash example again. Why do we want to do it? Well, fertilizer prices have come down because of recession fear. Pot stock has plunged and then settled down. Investors fear China is slowing economically and commodity prices are falling as a result. So the world's falling. However, food demand is held up strong. It hasn't slowed down. Fundamental and technical analysis indicate that potash is now a buy. It trades at a 4-year low, and it's pretty unlikely that a significant price drop is still in the cards. In fact, it's probably oversold. So the stock's fundamentally cheap. Fertilizer prices have to rebound eventually. Worst case would be in the next economic cycle. The stock has already fallen from $61, and food demand is still high. So what's not to like about this strategy? Well, let's look at put writing for income. So we want to own 1,000 shares of potash. We really do. So instead of buying 1,000 shares of potash, we write, in other words, we sell 10 April 2017 $22 put options for $1 a share. So in other words, if you multiply that out, that gives us $1,000 in premiums. And the additional benefit here is this income, which we're going to receive, comes to us as a capital gain. So we're receiving income, but in the most tax efficient way we can possibly get it. Also, we do have to set aside $22,000 in our account to cover the potential purchase of potash. Don't forget, there's no guarantee the stock won't go through $21. If it does, well, $22 because we sold a $22 put. But if the stock goes through $22, we have to buy the stock at $22, no questions asked. So, if we get exercised and the breakdown price is $1,000 below our purchase price, so instead of paying $23.95, we get the stock for $22.95. So if we like the stock at $23.95, this has to be a good deal and $1 cheaper. So let's assume the stock goes below 21 in April. So we don't have to don't have to buy the stock in. So we will not be put in April because the stock did not go to 22. Therefore, we keep our $1,000 profit. So what's the next? How's that work out? How does that profit break down? Well, we get a $1,000 capital gain from the premiums. The $22,000 we set aside in case we had to buy the put doesn't get used. So the total profit is $1,000 or 4.75% in 4.5 months, which represents a 12% annualized return. And we still have our $22,000 in our jeans. Now, strategy number 2 is writing calls for income. Well, we were bullish on potash, right? So we buy 1,000 shares of potash at $23.95. The cost $23,950. We write 10 potash $25 April 21 calls for $1, and we receive the $1,000. Now the purchase cost of potash is $23.95 minus $1,000 is $22,950. And we assume that the stock goes to $25.50 by April 21st. So if that happens, what's the profit? Well, the stock went above 25, so it got called. So we keep the $1,000 option premium because when we sold the option, that's ours to keep. So our total gains are the $1,000 plus the $1,050 gain from the stock sale in 4.5 months, plus the $135 Canadian dividend that 1,000 shares of potash paid out during that time period. because it paid dividends February 2nd and May 2nd. We owned it through February 2nd, so we get the dividend. So the total gain is on $23,950 invested is $2,185 or 9.2% in 4.5 months or 24.32% annualized. That's a nice return. This technique does limit your upside and it's very conservative, but that doesn't mean to say it doesn't make you pretty good money. Strategy number 3 is another interesting approach. Perhaps you could consider an ultra-conservative approach. So what we want to do is use a little bit of put and call writing. So in other words, we're going to sell some puts and some calls to take advantage of it both ways. So we still want to own 1,000 shares of potash. We'd love to do that. And we're happy with it at $23.50. We buy, or $23.95, sorry. We buy 500 shares at $23.95. So our cost is $11,975. We write 5 out of the money April 20th, 2017, $25 potash call option contracts, which are covered by our 500 shares that we purchased. We receive a $500 premium. We also write 5 out of the money April 30th, 2017, $22 potash cash covered put options, and we receive a further $500 premium. Don't forget, we get to keep those $1,000 premiums no matter what happens, but we will include them in our calculations to determine our profit in a moment. So considering the profit, the total income generated is $1,000 from the option writing. We still get that $135 dividend from the 500 shares of stock. So 3 scenarios unfold. The first scenario, potash moves to $25.50 by April. You get called, you sell the original 500 shares you bought at $25. The profit generated is $525 from the stock sale, $1,135 of premiums and dividends, or $1,660 total for 6.93% in 4.5 months. Geez, that's about a 20% return. That's pretty good. Then scenario number 2, potash trades between $22 and $25. So both options expire worthless. We generate a $1,000 premium. We get the $135 in dividends. So $1,135 or 4.74 in 4.5 months. That's not too shabby either. And scenario number 3, potash gets exercised at 22. In other words, the puts get exercised. The calls expire worthless. Average cost of our shares is now $11,975 plus $11,000 originally invested. Sorry, that we have to put in at 22. Minus the $1,000 premium received, minus the $135 dividend. So our total cost for our 1,000 shares is $21.84. If you like potash at $23.95, and you like the fact that it was a great stock with great fundamentals, with a dividend that qualifies for our rules-based investment strategy, how can you not like it even better at $21.84 as a break even? And you're not precluded from writing call options against that again and either lowering your cost further or getting exercised and reaping a profit. This art is not all lost. Option writing portfolios can provide excellent low-tax returns over time. The best program in our option is the cash-covered put writing portfolio, strategy number 1 for the potash example. It does require an experienced wealth professional to perform, and it requires work, diligence, and expertise. Unfortunately, most firms don't teach their rookies this technique anymore. And there are some important points for the investor and the advisor. First of all, find which stock to buy using the rules-based investing approach. Shop on the options exchange for good premiums to receive. This alone justifies the fee to pay for this service. Stick to large, capitalized, liquid, blue-chip companies. No junk. And finally, should only be performed in a fee-based investment account where there's one annual percentage fee which covers all the transaction and administration costs to maximize your net returns. And on top of that, it's the best one for the advisor too. So it's a win for you and a win for the advisor, which is always a great solution. Put writing portfolios can make for great, steady, long-term return. So Let's finish with a little cartoon. We got Stephen Hawking, who warns that aliens may come to Earth and suck our resources dry, leaving us conquered and exploited. Too late, Goldman Sachs is already there. That's the end of the options segment. Thanks for listening.